Good day, thank you for joining me. My name's Warren Davison and I'll be taking you through the May 2020 PSG Offshore Fund performance. Setting the macro theme. Equity markets rose on the whole in May as COVID-19 lockdown measures began to lift and further support measures were announced. Escalating tension between the US and China, however, limited emerging market equity gains. Looking at the US, their shares gained ground amid optimism over the reopening of the economy. Q1 GDP growth was revised down to negative 5% compared to the first estimate of negative 4.8%. Eurozone equities advanced as some countries began to allow some parts of the economy to reopen. The European Commission proposed a €750 billion recovery package, which helped ease market sentiment. UK equities also rose in May. A number of economically sensitive areas performed well amid the improvement in investor sentiment. The sterling fell as worries over a non-Brexit deal resurfaced. Japanese equities posted gains, with pharmaceutical stocks leading the advance. Lockdown across the country were lifted in stages during the month. Emerging market equities advanced, but some underperformed developed markets. The performance was dampened by the re-emergence of US-China trade tensions. Digging deeper into the fixed income indices, as this is a section which normally gets questions. Due to the risk-off sentiment, emerging market bonds, corporates, and other high-yielding fixed income spreads widened, caused by the negative price movement. Looking at the recovery now, corporate bonds outperformed government bonds as the more optimistic backdrop saw investors favor higher risk assets. The US 10-year government bond yields were little changed during the month. What I've also included is a return matrix taken from Goldman Sachs, which breaks down the fixed income indices into their different maturities, looking at government, corporate, and high yield. What one notices is that in this tricky environment, growth assets have sold off, which include high yield bonds and other corporates. Taking the US for example, we can see long-term treasuries held up on a year-to-date basis. On the flip side, high-yield bonds were not a great place to be, as these yields blew out in February and March. Looking at the month-to-date data, we can see that the strong risk-on sentiment caused high-yield bonds to outperform their corporate and government counterparts. Before we get into the funds, it's important just to remember the PSG philosophy around the multi-manager portfolios. Our objective is not to back one horse, but rather to spread the bets across horses which we feel have a competitive advantage at what they do, whether it be their style or thinking. We then combine these portfolios to produce one underlying portfolio solution, with the objective to achieve our three pillars of 1. Consistent above average performance, i.e. first or second quartile, below average risk by focusing on the Sharpe ratio, and at a competitive price relative to their industry peers. Now moving into the portfolios, looking at the asset allocation. It's important to remember that these PSG Wealth Global Fund of Funds are multi-asset portfolios and therefore include both equity and fixed income investments. Speaking to their fixed income investments, and as I mentioned earlier, this will include exposures to government, corporate and high-yielding fixed income securities. Moving on to the fund's performance. Looking at their relative rankings, these remain strong across the board with a strong bounce back with risk on sentiment. Longer term numbers are always favorable. Over the recommended holding period, illustrated by the rectangles, here we have achieved above average performance for 5 of our 6 fund of funds. The PSG selected managers had an excellent month, with 86% of our underlying managers outperforming their peer group. Value stocks lagged growth, again with the MSCI World Value and the MSCI World Growth returning 2.9% and 6.5% respectively for the month. Looking at our risk radar, the managers bounced back strongly for the month and all funds have come off the quantitative risk radar. Templeton Global Balanced and Schroders Multi-Asset Growth and Income, however, remain on a qualitative radar due to manager changes. Looking into the Global Preserver, the fund produced a 2.49% return in May and outperformed its sector for the month. The fund has unfortunately fallen behind the sector over the recommended holding period of 3 years by a narrow margin. As you can see from the relative tables, the 3-year number has felt the pressure of the global sell-off. However, longer-term numbers remain first and second quartile. It is important to remember here that the fund does hold roughly 20% in equity and will experience increased volatility during times like this. The Global Moderate produced a return of 2.79% in May and again outperformed its sector by 33 basis points. The fund is above its benchmark over the recommended holding period of 5 years. And looking at the ranking table, the fund remains above average over all observed periods. Onto the Global Flexible. The fund produced a return of 3.2% in May, outperforming the sector for the month by 92 basis points. The fund outperformed its sector over the recommended investment of 7 years and again by 5.51%. Looking at the relative tables, the fund has held up exceptionally well with top quartile performance over all periods. Finally, with the Global Creator, the fund produced a return of 4.51%, outperforming the sector for the month. The fund is also above the sector average over the recommended investment horizon of 7 years. And again, as you can see from the relative tables, the fund has held up exceptionally well over all periods. Just a final conclusion. As we can see from each of the fund delivering on the 3 pillars, we strive to achieve consistent above average performance with below average risk at a competitive price relative to peers. What you can see from our 4 global funder funds is that 3 of them have achieved all 3 pillars. We have recently made changes to the Global Moderate and feel the fund is better positioned to meet these 3 pillars going forward. Thank you for joining us. If you need anything further, please do not hesitate to contact us.